Hey there, welcome to the channel. So it looks like the market finally took a step down. All right, so very interesting. So yesterday we had Fed Day. So Fed Day here, I'm looking about 6 days. So we had Fed Day. We couple days before we had this big sell-off. We were selling off, and then they ramped this thing up a few days ago to get it up to some kind of a reasonable level. So it kind of went up, got to some reasonable level. So then we go to Fed Day, and of course it starts to go down a little bit. They increase things rates by 50 basis points. Okay. But for some reason, the market just took off after that. And as I was saying yesterday, I'm like, what the hell is going on? Why on God's green earth would the market be going up? The Fed raised by 50 basis points. The Fed indicated that for the next few meeting, they're going to raise by 50 basis points. It's an amazing thing because you're like, what the hell is the market thinking? What are people thinking? Are you really thinking that the Fed can get this right and that they can magically crank up rates by a couple percent in a few months and that it's not going to break anything? It's just beyond silly. So today, now we kind of get we get a response finally that maybe, and this is just my opinion. That's all. And and the reality is the market is always right, and we as people that are trading in the market, active in the market, we're always wrong, right? The market is what's right, and we just have to kind of figure out and deal with what we're being presented. So today, just took a big old crap. I mean, this thing is down 5% on the Qs. It just sold off pretty much all day, and then they finally got a little rally at the end. So what's interesting here is I kind of drew. So within this trading range of about 5 to 7 days, you have this high around 329 in the Qs and the low of 310. So they just held it. So once again, look at this. They just held this line, this 310 line. They came in at the end. Look at all that volume that came in at the end just to drive it up a few points to get it from 310 to 313. So they worked really hard on that. So look, here's the thing with this market. If I look at it and try to look at it objectively, we have the Fed is really busy. They're cranking rates. They have high inflation. The Fed is, interestingly enough, in their statement yesterday, they're talking about how they're talking to the American people, how they have to basically get rid of this inflation. They didn't really talk much about concerns about what it does to the stock market. And I think that's very clear at this point that they don't care about the stock market. It's really simple. So the whole fact that it rallied yesterday made in my mind just absolutely no sense at all. So this, though, is something that we should expect. It's pretty typical for like a bear market. And that's what I believe we're in. We're still at the early phases of the bear market. It's still, a situation where we've had this uptrend. We've broken the important 200-day moving average or the 50-week moving average. We've had the death cross. We came up and we rallied into it and could not hold it on the Qs, and we're working our way back down. And we have, conceptually, when I showed it holding, it was holding the low from the previous week. Okay, it got back up above the low of the previous week. That's what happened today, but it's still at a new low. It's still lower than the previous low here. So we're actually still working our way down. The next support is maybe a little here. It's at the same point, maybe something here. It's just working its way down, and that's what it is. So I found it funny yesterday to think, like, what are people thinking? Are people really thinking that the Fed can get this right? They never get it right. When you look at all those charts, you kind of look every time they raise rates, at some point later, they just break the market, they break the economy. And now in particular, it's even worse because we have more debt than ever. So it's a very simple thing. We are at record debts. So let's take a look at that. Yeah. So looking at the national debt clock here, we're over 30 trillion in debt, and there's no hope of ever even slowing the rate of that debt down, much less actually paying it off or reducing it to some kind of sustainable level. So it's just on a unsustainable trend. So therefore, if you're looking at it and you're saying, how can the Fed get this right? If the Fed is raising rates, which is directly going into this $30 trillion of debt, this $30 trillion of debt, most of it in the shorter end of things, which is positive from the point of view that the shorter term debt will have a lower interest rate. That's great. But the other problem is, like, if you're issuing 33-month debt, You're issuing T-bills, 1-year debt, 2-year debt. You're constantly rolling over. And this is exactly what's happening right now. And it's interesting because over the last few months, there was actually a reduction in the number of treasury auctions. They actually reduced it because they actually had, they're just managing this thing week to week, month to month. Treasury is managing, and they just actually had, they didn't have much demand for it, but it will come back. It will come back. So if you understand it, look at it this way. This debt, a big chunk of this debt is all short term. It's all less than a year. So when you're sitting there and you're looking at like a 10-year, or you're looking at a treasury. Okay, so if you're looking at this national debt, we're at 30 trillion national debt. Much of it is financed at very short term. This debt is like less, 1-year debt, 3-month debt, 2-year debt, et cetera, 5-year debt. And at the same time, look at this. This is the 2-year. Take this as a proxy. This thing went up from, it was hanging around 0.2% for the longest time here, 0.2%. And now it's up at 2.7%. That's huge. Do you understand that when you're looking at that and you're looking at the national debt that's continually going up at 30 trillion, and much of this financing is being done at short term, 1-year, 2-year bonds, and the rates just spiked on it. The rates just tripled. I mean, you're talking 0.2 to 2.7%. It's a huge increase in those rates. Do you know what the amount of the budget that's going to have to go to pay on that debt? It's totally unsustainable, and it's prone to something breaking. And that's exactly what's happened. The Federal Reserve, although they've only raised a little bit, this is the effect that they have, right? You have to understand this US Treasury. This is the effect that they have. If we look at the 10-year, we can see that as well. This is the effect they had. They were 1.5, they're at 3, right? They doubled the rates at the 10. They tripled, quadrupled the rates at the 2. So now the Fed hasn't raised rates this much yet, but the Fed is telling the market to do this, right? It's signaling, it's cajoling, it's using the bully pulpit of the Fed to get the market to push the rates up to try to kill the inflation. That's what's happening. Now, if you look at this thing, you've got to be kidding me, right? You've got to be kidding me. This is like a huge increase already. The amount they've always raised has already broken something. We just don't know where it is. All right. So finally, we get a rational response in the market by finally selling off in response to the Fed's rate increase. Oh, stupidity. Talk to you later. Bye.